Welcome back to the Effect, and it's your weekly recap for the end of the week for April 24, 2026. From a tech breakthrough that is so scary that it's being treated like a digital nuclear asset to a $200 billion check refund from the government, we've reached a point where the speed of innovation is colliding with the hands-on friction of legacy systems. Whether it's Apple crowning a new CEO to AI hardware changes, or the IRS shrinking its human footprint in a high stakes bet on automation. Let's get started with our first story. If the first rule of AI Club is that you don't talk about AI Club, the first rule of Anthropic's new model, Claude Mythos, is to not give it an internet connection. This week, the tech world was rocked by the revelation that Anthropic has developed a model so proficient at finding and exploiting software vulnerabilities that effectively put it under a layer of lock and hidden it. Anthropic's Project Glasswing leaked details that were later confirmed in a high-level government briefing. Mythos isn't just a better coding assistant, it's a digital locksmith. In the early testing, it didn't just find bugs, it found 0 days that have survived decades of human scrutiny. Mythos discovered a critical vulnerability in OpenBSD that has been sitting in the code for 27 years. For context, OpenBSD is widely considered the gold standard for high security, hardened operations. It flagged a 16-year-old bug in FFmpeg, which is the backbone of almost all web video services, that has reportedly hit automated testing tool 5 million times without being detected. And more alarmingly, during a red team evaluation, Mythos managed to escape a security sandbox without being prompted and sent an unsolicited email to a researcher. This isn't just like a concern for Silicon Valley. It's a risk for Wall Street. Last week, Treasury Secretary Scott Bessman and Fed Chair Jerome Powell held a substantial awareness meeting with the CEO of the 5 biggest banks, being Goldman Sachs, Morgan Stanley, JP Morgan Chase, and others. The fear was that it could lead to a debt bankruptcy. If a model like Mythos or other open source competitors that catch up to it within the next 6 months can automatically chain itself together with 5 minor vulnerabilities, it could create one catastrophe that can be exploited. The global financial ledger could be wiped out and manipulated faster than people can fix it or be aware of it. Instead of a public release, Anthropic is forming more of a group where only a handful of entities, including Apple, Microsoft, Google, and the US Treasury, are getting access to the defense tool called Mythos. The strategy is to use AI to find and patch the most vulnerable and critical infrastructure flaws before bad actors can use their own model to exploit it. Prediction markets currently have a 40% chance that Anthropic holds the number 3 AI spot by the end of the month. But with the government-backed deployment, they might be pivoting towards consumer product company to a critical national security asset. And moving on to our next story, which involves the government and our tax system. If the IRS isn't your best friend, it's basically on a way to start cutting its own group circle. The IRS is now shifting its labor-intensive workforce towards a more machine and tech-first lean operation. Here are the numbers coming out of the Treasury. Since the start of the current administration in 2025, the IRS has shed 28,000 employees. The goal was to budget documents released this April suggesting the target workforce to be under 30,000 people, which is a far reach from its 100,000 peak workforce just a few years ago. The logic being that the IRS leadership, including the CEO, who has stepped in a private sector efficiency mandate, argues that AI and automation modernized can fill the gap. The recent proposed addition of $1.4 billion in reduction in funding, banking on the technology that can help sustain this performance. For the average taxpayer, this means that the taxman is moving away from its legacy and more towards the modern age. However, the individual audit rate has cratered to just 0.4%, and the corporate audit rate is at a 0.66%. It isn't just about the numbers, it's about talent. The IRS has lost roughly 40% of its IT staff and 80% of its executives. Critics warn that while the agency wants AI auditors, they don't have enough human experts left to build these systems and oversee them. This isn't just about wanting a smaller government. It's a massive gamble on the nation's income. The Wall Street Journal reported that this week there's enforcement cuts that could cost the US hundreds of billions of dollars in lost revenue over the next decade. And this creates an incentive problem. Tax lawyers are reporting a shift in taxpayer behavior. When the risk of being caught diminishes, the appetite for more aggressive deductions and riskier accounting tricks grow. While the IRS claims that it's still prioritizing the $400,000 plus income brackets, the loss of specialized investigations means more complex offshore structures and pass-through entities. Meanwhile, they are less effective at actually catching them, leaving them behind when actually auditing these companies or people. And talking about people, our next story deals with that. This week, we saw a classic tale of two tapes. The government inflation data was flashing red, but the credit card data from consumer offices is flashing green. The latest CPI report for March isn't pulling any punches. Headline inflation jumped 3.3% year over year, up from 2.4% in February. And the biggest culprit is the energy bill. Gasoline prices surged 21.2% month over month, a direct cause from the supply chain knots caused by the Strait of Hormuz. When your commute costs 20% more than it did 30 years ago, that's transitory inflation, but it feels a lot more permanent than before. Despite the price tag shock, the message coming out of the Bank of America's Q1 earning call and the general vibe of the Wall Street is that American consumers are still somehow spending like it's 2025. Total credit and debit card spending per household climbed 4.3% year over year in March. There are people citing that the persistent stimulus effect of the One Big Beautiful Act passed last year is a major support beam for household balance sheet. However, if we look under the hood, it's a lot messier. Higher income households are driving the growth, while low income households are basically tightening their belts. They aren't seeing a total breakdown. We're seeing a widening divide between who is spending and who is actually being impacted by these prices. The market is doing some serious mental math here. Their energy prices dragging headlines inflation upwards. The Federal Reserve is a higher for longer stance, looking for a policy that is more necessary. Traders are now bracing for the upcoming meeting on April 28th through 29th. The big question for the rest of the quarter is the consumer actually doing fine, or are they spending their savings just to cover their grocery bills and, more importantly, their utilities and gas bills? How long can the bank cushion actually last them before they start spending and going into debt? And this goes on to our next story about the new upper middle class. While the headlines often demonstrate that there's a struggling squeeze in the middle class, it's actually a little bit different. There's a shift happening. The massive migration from American households into the middle class are different. They're shifting more into the upper middle class, which is classified between $100,000 to $350,000 annual income per household. This isn't just about inflation pushing numbers higher. It's a structural change in the economy of its rewards in specific skill sets. Recent data suggests that the percentage of Americans living in the upper middle class household has climbed over 31%, up from 12% in the late 1970s. This is now larger than the lower middle class for the first time in history. The drivers isn't coming from traditional manufacturing. The gains are concentrated in highly specialized sectors like healthcare administration, technical project management, and most notably, the AI layer of the workforce. The rise of this demographic is high-earning households are increasingly power couples, two specialized professionals combining forces to cross that $250,000 threshold, creating a massive gap between them and single-family households. But moving up the ladder doesn't make them feel like winners or wealthier. The new upper middle class is still primary target of premium inflation. The cost of buying into the upper middle class lifestyle is basically private tutoring, specialized daycare, and youth sports, which are twice as fast as the core CPI. Even with a $200,000 salary, many of these groups find themselves locked out of prestigious zip codes that their parents once occupied with a single middle class income, largely due to how supply-demand mismatching these high productivity cities. This is creating a shift on how the markets operate. We're seeing a luxury light ecosystems start to thrive. Brands that aren't quite as luxurious, like Hermes, are far above Walmart. From high-end fitness memberships to premium travel, this demographic is the engine that keeping consumer resilience basically alive and discussing in the banking section. The big question for 2026 will be if this group feels like they've arrived at their final destination in terms of earning income and they feel comfortable, or will they still feel like they're struggling like they did before? And moving on to our next story. If you thought getting a refund from your mobile carrier was a headache, now imagine trying to claw back $166 billion from the federal government. On Monday, April 28th, U.S. Customs and Border Protection officially opened the floodgates, launching a brand new digital portal for businesses to claim refunds on their tariffs that the Supreme Court recently ruled were illegal. This isn't just a minor accounting correction, it's a massive financial unwinding. Back in February, the Supreme Court handed down a landmark decision in Learning Resources versus Trump, ruling that the administration oversteps its authority in using International Emergency Powers Act to slap tariffs on a wide range of imports. The court essentially said the emergency wasn't an emergency and the taxes shouldn't have existed in the first place. And now the government has to pay it all back. While the CAPE portal, Consolidated Administration and Processing for Entities, is live, it's basically still a rough website. Importers are reporting a mixed bag. Some businesses are getting their submissions approved in minutes, while others are staring at the system riddled with technical glitches and just red tape everywhere. But here are how it looks for the Americans right now. An estimated $166 billion and $200 billion are owed. Currently, the system covers only about 60% of the affected entities. Most recently, imports that have been fully finalized in the customer systems. But for those who are lucky enough to go through a portal and get approved, CBP says checks rather than electronic transfers should arrive within 60 to 90 days with interest. So that is a pretty good part. While small business owners are refreshing their bank account balances, moving on to our next story, we're heading to Europe. If you were planning a trip to London or Paris this June, you might want to check with your airline because they're actually running out of fuel over there. On Thursday, April 16, the executive director of International Emergency Agency, IEA, issued a chilling ultimatum. Europe has approximately 6 weeks left of jet fuel in its reserve. And we aren't just talking about the high ticket price anymore. We're talking about the physical absence of this jet fuel. The root cause of this crisis is still the Middle East conflict that effectively closed the transport of these fuels. And while most of us were focused on the crude oil aspect of everything else is also getting choked out. About 25 to 40% of Europe's jet fuel imports go through this strait. And with no tankers passing through it, it's basically escalated to a warning pretty fast. And now the continent is eating through its stockpile at an unprecedented rate. The IE's report paints a pretty dire picture of the global economy. In a normal year, European countries maintain several months of inventory. As of this week, that buffer has evaporated. Some regional hubs have reportedly down to last 20 days of coverage. And the industry is already reacting with a tragic mindset for the potential summer season. Lufthansa and KLM have already begun slashing thousands of flights through May and June. These aren't just low occupancy routes. They're cutting flights that are no longer financially valuable due to the price of jet fuel hitting a record 1,838 per ton this month. Some short-haul carriers are now tankering, filling up their planes with extra fuel in the UK or the US to avoid having to fuel in departing European airports. It's an expensive, heavyweight flight. This crisis is creating a massive divide between the ones who have the fuel and the ones who do not. Carriers like Ryanair have hedged 80% of their fuel at lower prices, having a massive competitive advantage. Meanwhile, smaller, unhedged airlines like Wizz Air are looking basically to survive the summer. The jet fuel shortage is a localized symptom of what the IEA calls a larger energy crisis that they were forced into. While the U.S. is currently buffered by its status as a net exporter, sending roughly 150,000 barrels of jet fuel per day to Europe to help basically fill in this gap, it isn't enough to replace the lost volume from the Middle East. If the strait doesn't open by the end of May, the 6 weeks clock basically running out and making traveler season a whole lot worse. And the worst case scenario is a whole halt of this airline travel. But even if they signed a ceasefire within the next couple of days, it'll take everything to normalize again sometime. It isn't instant. And moving on to our next story about companies. If you thought the tech world was basically settled and good for now, Apple just dropped a shift that would define the next decade. On Monday, April 20th, the company officially announced that Tim Cook is stepping down as CEO, effective September 1st, 2026. Cook will transition to the role of executive chairman, passing the torch down to John Ternus, the current senior vice president of the hardware engineering. This isn't a sudden departure or a secret board meeting that just happened. This has been decades worth of succession planning. Cook isn't leaving the building. He will focus on policy and government relations, but the day-to-day work will still be handled by the man who spent the last 25 years building physical products we hold in our hands. The choice of John sends a pretty clear signal to Wall Street. Apple is doubling down on its identity as a hardware-first innovation powerhouse. While Cook mastered the supply chain and margin optimization, Ternus is a product guy through and through. Since joining product team design in 2001, he has been the primary architect behind iPad and transition to Apple Silicon and the latest generation of iPhones. The market's held steady. Apple shares dipped a mere 0.6% pre-market following the news, which is a sign of immense confidence. Ternus is inheriting a company that under Tim Cook's leadership saw a market surge from $350 billion to over $4 trillion. Unlike many tech CEOs who come from a finance or software background, Ternus is credited as the sole innovator by Tim Cook himself. His evaluation suggests that Apple believes the next generation of growth lies in physical engineering breakthroughs like AI integrated devices and the next generation of computing. Apple is at a crossroads, shifting from its focus from hardware sales to a future definition by Apple Intelligence. While Ternus has mastered the Mac and the iPhone, his first year as CEO will be judged on one thing: how will he integrate these AI technologies into the ecosystem? With recent partnerships with Google to bring Gemini to Apple devices, Ternus will need to prove that he can lead not just a hardware firm, but a software-driven AI titan. Analysis at Goldman Sachs and Morgan Stanley have already pointed to 2026 as the year Apple must deliver a truly compelling AI product to justify the current evaluation. By promoting the man responsible for the M series chips, Apple is betting in a big way that they will win the AI war. Moving on to our last story. If you thought filing for bankruptcy once was a reset, Spirit Airlines is proving that a second time around is where the real strategy begins. On Thursday, April 23rd, lawyers for the low-cost airline revealed in a New York bankruptcy court that they are in advanced talks for a federal lifeline. This follows their second Chapter 11 bankruptcy in under 2 years. A move so rare, it's unknown how the industry will handle this. And it isn't just about survival, it's about a Spirit merger ready. After the Department of Justice blocked the JetBlue Spirit tie-up in 2024, Spirit was basically left with a mountain of debt and an aging business model. By entering bankruptcy now, they effectively using the court system to strip away the toxic parts of their balance sheet, slashing aircraft leases and cutting debt from $3 billion to roughly $2 billion, to present a clean, lean version of themselves for a potential suitor. The big shocker this week wasn't just the filing, it was the bill. The White House has confirmed that it's weighing a $500 million taxpayer-funded takeover. The plan, as described by the administration, is to take a majority stake in Spirit via senior loans and equity warrants to stabilize the airline, and then resell it for a profit once jet fuel prices stabilize, currently spiking due to the Middle East as we spoke earlier. The administration wants to save 11,000 jobs and protect Spirit's valuable takeover and landing slots at major hubs in Newark and New Orleans. By keeping Spirit alive, the government prevents a total liquidation, which will leave the budget travel market entirely to Frontier and Allegiant, potentially driving up fares for everyone else. Spirit is already using their restructuring to move away from its no fillers route, adding bigger front seats, premium economy options from its major competitors. While the government talks about its bailout, the industry is looking at JetBlue. Just yesterday, JetBlue CEO issued a memo stating that while it won't file for bankruptcy in 2026, they're exploring all merger options. For JetBlue, buying a liquidated Spirit has always been the dream, getting the assets without getting the debt. By using the Chapter 11 bankruptcy to wipe out nearly $1 billion in financial obligation, Spirit is essentially putting itself on a clearance rack for buyers who were previously scared off by the high price tag. However, there's still high political friction. Senators on both sides are basically dotting their I's if it's a good idea to throw good money at a bad company, if the government-backed airline can truly be still competitive while these jet fuel prices are insane. Spirit is currently burning cash faster than its jets can actually take off. The next few weeks will determine if the bankruptcy is a bridge to a new merger or if that's it for the yellow airplanes. Well, that's a wrap for this week's breakdown. From the legal tax refunds hitting your bank account to the new Apple era and all these airline troubles, it's basically a rough week. But thank you for listening. Until next time.